Hi everyone, welcome to Option Strategies. In this video, I want to talk about how I plan to trade Amazon with option after the recent sell-off due to the disappointing earnings announcement. On October 27, 2022, Amazon reported Q3 earnings of 28 cents per share, which beat the consensus estimate of 22 cents per share from 35 analysts. However, the company Q3 operating income, net income, operating cash flow, and free cash flow all decreased compared to third quarter of 2021. Besides, Amazon expected Q4 revenue of 140 billion to 148 billion, also lower than 155.37 billion that analysts has hoped for. Amazon stock price dropped to new 2-year low after the earning announcement. Looking at the 5-year chart of Amazon, I noticed the stock price recently break through the support level from 2018 and 2019. Next support level will be around $85 or $81 of COVID low. My assumption now is a good time to get into Amazon for long-term investment. However, the stock price may still drop further to the $81 support level. Remember, this is my assumption and it's not a trade recommendation. So, how can I trade Amazon from here? The first option strategy that I can use is selling a put. This is a profit and loss profile of the strategy. The trade is set up by selling a put option at a strike price that I like. With this strategy, I can choose the strike price that I think is the next support level. In another word, I can choose the price that I'm willing to pay for Amazon stock. If Amazon stock never drops below the put option strike price, the profit of the strategy is limited. The risk of the strategy is unlimited as Amazon stock price can drop down to zero, hence makes this strategy risky in current market environment. The second option strategy that I can use is selling a put vertical spread. This is the profit and loss profile of the strategy. The trade is set up by selling a put option at a strike price that I like, then buy a lower strike price put option. Even though I can choose the strike price that I want to sell the put option, but I need to consider the reward versus risk that I want to take with the strategy. Wider spreads provide higher reward and higher risk. Narrower spread has lower reward and lower risk. The risk of the strategy is limited. The highest risk is the width of the spread minus the premium I collected. The third option strategy that I can use is selling a broken wing butterfly. This is a profit and loss profile of the strategy. The trade is set up by sell a call option, then buy a higher strike price call option. At the same time, also sell a put option at the same strike price as the call option that I sell, then buy a lower strike price put option with the put spread width is double the width of the call spread width, and the premium collected is higher than the call spread. With this strategy, I'm limited to the strike price that I can choose. However, the strategy has higher reward to risk ratio and able to make big profit if the stock price drops to the strike price that I sell the call and put option. The risk is limited. The fourth option strategy that I can use is selling a broken wing iron condor. This is a profit or loss profile of the strategy. The trade is set up by selling out of the money call and buy a further out of the money call option. Then selling out of the money put option and then buy a further out of the money put option. The put option spread is wider than the call option spread and the total premium collected is more than the call spread width. The strategy is with limited profit, and the maximum profit is made if the stock price stays at current level when the option contract expired. The risk is limited. Thank you for watching, and remember, all trades discussed in this video are not trades recommendation.